Hi everyone, I'm Ryan, I'm the deals editor at The Block, joined by Peter Smith, CEO of blockchain.com. We're here to talk about why 3 Arrows Capital, the collapse of 3 Arrows Capital hit harder, and we've got 15 minutes to do it, so we better get started. For those of you who have been living under a rock, 3 Arrows blew up just before this event last year. It was one of the biggest hedge funds in the space, invested in tokens, invested in startup equity, bought NFTs, went bankrupt I think in about July last year, and has been in the bankruptcy process ever since. I think it owed creditors in the region of $3.5 billion plus when it went bankrupt. And here we have Peter to talk about why that was such a big deal for the space. So Peter, maybe we could just start. Quick introduction to yourself and also how blockchain.com fit into this picture of 3AC.
Sure, and it's great to be here today. I've never really done one of these talks like adjacent to a nightclub sound, which I've been doing crypto and crypto events now for almost 10 years, 1 month shy of that. So it's rare for me to have a new experience, but yes. It's good to have one. So blockchain.com runs a large institutional business in the space where we do a lot of OTC trading, both in spot and derivatives, as well as providing margin loans, as well as structured credit. And 3 Arrows was a longtime client. We were one of their sort of first counterparties when they were getting started out. And I think one of the interesting things to reflect on with 3 Arrows is that while they did go bankrupt and lose a lot of money for a lot of folks, they were for a few years probably the dominant hedge fund in the space.
Yep.
They were by far the largest, the most aggressive, and frankly, one of the most talented sets of traders out there in the market. And of course, as has been written about a lot since, they got offside of the market and went bankrupt. And it's interesting to reflect on why. We were a service provider to 3 Arrows Capital. We were a lender to 3 Arrows Capital. And so we've seen a lot of the sort of rise of 3 Arrows as well as the fall. And then as a very active participant in the institutional market, as well as the global crypto markets, we've seen a lot of the effects of that as it's played out over the last year.
Okay, I know we'll talk about it throughout the session, but you see sort of 3 big reasons, don't you, why this sort of triggered such a domino effect in crypto credit last year. Can you briefly outline those for us?
Sure. So I think the first thing is that crypto had been a relatively high trust environment for a long time. It was sort of a very small group of people that built most of the big crypto companies, funds, investment firms. And there was this sort of like almost naive trust that was based on the idea that we were all had a common purpose or common mission of building a new financial system. And so there's probably a higher level of trust between counterparties than maybe was warranted. And I think that the 3 Arrows collapse really was the first thing that made a lot of people question that. And it made the market really nervous about counterparty risk. And so you saw after that a lot of institutional funds began pulling capital, pulling credit lines, which began to exacerbate the sort of market unwind that we were experiencing this time last year. And that put a lot of pressure on crypto companies all throughout the market, which later went on to blow out, notably FTX and what have you. But it wasn't really anything specific that 3 Arrows did besides their default on their lenders. It was this sort of, you woke up one day and you realized that you had gone from a high trust, common mission environment to a space where that probably wasn't true anymore because of how big it had gotten, and it made people really nervous and aggressive about managing their counterparty risk, which in the long term is probably a really good thing for the resiliency and maturity of the space. In TradFi, they're not united by a common purpose. They just kind of manage ruthlessly. But it was definitely a paradigm shift for the market participants at the time.
Yeah.
The second way that it really impacted things is that most of the major lenders, including ourselves, called back all of their under-collateralized loans. And one of the big borrowers of crypto in the space is actually crypto market-making firms. And so over the last year, you've seen a real collapse of liquidity in the market. The global crypto markets today are maybe 15% as liquid as they were 16 months ago. And so that liquidity has given rise to a lot of intraday tick-by-tick volatility, and it's made it very hard to execute larger trades in the space. And so that pullback of credit has really changed the shape and market microstructure of the global crypto market in a pretty fundamental way. And then the third thing is, just as in traditional finance, most loans to big companies, institutions, hedge funds, are made by banks that source capital from retail or other customers, and then lend that capital out. And then they have a provision on their balance sheet that says if we lose money lending, we're going to use this provision to make our customers whole on the other side. That's basically what was going on in crypto, except a lot of crypto companies had not made a big enough provision to absorb losses if their lending book took a loss. And so when the largest hedge fund in the space went bankrupt, there were a lot of downstream bankruptcies that impacted millions of retail customers. And so, we're thinking of Voyager here, we're thinking of BlockFi, we're thinking of Celsius, and then, a variety of other players in Asia and Europe as well, who had a lot of exposure to 3 Arrows or firms that looked like 3 Arrows. And the number of customers, retail customers that were impacted by that was, millions,
yeah.
right? And much greater scale than even the FTX blowout.
Just to come back to that point about trust, which I suppose is slightly ironic, given that we're in crypto where people are so fond of talking about trustless systems and things like that. But, why do you think it was the case that was it because of how the environment was at that time that people didn't have sort of higher disclosure requirements when it came to, holding 3 Arrows to account about what's your NAV at this point, what's your leverage at this point, where does the fund sit?
So, I don't know anything about other folks' business arrangements with 3 Arrows Capital, and I think that, for me, I can only speak in a sort of general sense about the 3 Arrows situation. The reality is that disclosures and risk reporting only work when the reports submitted are accurate. Mm-hmm. And so I think sometimes you see on Twitter, why wasn't the reporting, why weren't people asking for more reporting?
Yeah.
Most lenders do ask for a lot of reporting, but that is based on the assumption that you're given accurate reports, right? And so I think in time we'll get more reports from the liquidators of 3 Arrows, and we'll understand how accurate or not accurate that reporting may have been. But it does kind of rely on having accurate reports and making provisions for credit losses on your balance sheet, which a lot of other crypto companies failed to do. I think the other thing to say about the lending space in crypto is you're dealing with a really volatile asset class. Like this model of sort of prime brokerage and margin credit trading was ported over from TradFi. And there's no assets really, there aren't any sectors in TradFi that move with the same volatility as crypto. And so I think managing credit risk and counterparty risk in crypto is probably uniquely challenging in a way that most of the models from TradFi and risk models were totally unprepared to tackle in the digital asset space.
I guess you've kind of alluded to an answer on this front, but do you think the reports you received were inaccurate?
I can't comment on that question at this time.
Okay. What about the bankruptcy process itself? It's obviously been quite uniquely complex. It's, there's been back and forth in some ways between the founders and Teneo, the liquidators. In other ways, it seems like they're not perhaps working together as closely as they might be. Does that ramp up the impact of this sort of an event on, retail customers perhaps, but also the companies that are involved?
In an ideal world, when a trading firm goes bust, the staff of the trading firm help unwind that firm's positions in an as orderly and expeditious fashion as possible. That, from reading the public filings, has certainly not been the case with the 3 Arrows liquidation. There's this sort of strange habit in crypto of having discussions over Twitter, which I still don't understand after 10 years of doing crypto. And it's definitely a very heated discussion between the founders of 3 Arrows and the liquidators on Twitter. That's quite valid and very frustrating to watch.
Yeah. I know Arthur Hayes has been trying to reach out to them directly via Twitter. In your position as a creditor, do you mostly just deal directly with Teneo and that's kind of it?
Yeah, so we work via the liquidator. We had filed to put 3 Arrows Capital in liquidation after we made a margin call that they were unable to meet.
Yeah.
Someone from our team, from our legal team, is on the creditor committee that is kind of responsible for overseeing the liquidators. it's not something I personally work on,
Yeah.
but it's definitely something that someone at blockchain.com works on.
Okay. What about the question of taking on more leverage as things were going wrong, which is something that Teneo has talked about and sort of has suggested that, some of the loans they took in those final days before the bankruptcy, which I suppose were to try and save the thing and keep it going, potentially exacerbated the damage that it did. Do you have a view on that?
Yeah, so Teneo has done a lot of work to reconstruct sort of the final year of 3 Arrows. One of the things that they have said publicly is that 3 Arrows continued to borrow right up until the end. I think their last loan was maybe only 8 days before they were, under. And I think that I will probably reserve my full view for the final report.
Yeah.
But if it turns out that they were knowingly, as a fund, borrowing, that they were unable to have any sort of viability to repay, and that they weren't being honest about the financial position of the firm, that would be incredibly disappointing to find out.
Okay. We're, just over a year removed from the bankruptcy itself, and obviously a hell of a lot has happened in that time. But where do you think crypto credit markets are right now? You're still one of the, the bigger lenders in the space. Where are we relative to, let's say, a year and a half ago?
You've had a massive contraction in the credit markets, and that's what I was talking about in reference to a contraction in liquidity as well. I don't see the credit markets coming back in the same way. I think applying the models from TradFi to crypto won't work. I think you'll see credit stay over-collateralized, which is where most credit deals are today. They're over-collateralized, sort of like margin facilities, which lenders, including ourselves and Galaxy, are happy to provide. Really only ourselves and Galaxy survived, right? So it's a very small market. Beyond that, I think most of the credit provision in crypto will have to be on chain.
Okay.
And so you've seen a lot of that sort of, flash loans and lending protocols. You've seen that grow, but once again, that's mostly over collateralized.
Yeah.
And so the crypto industry is going to need to find a way to finance liquidity and leverage in a more risk-controlled fashion.
Okay.
And I don't think the industry has quite figured that out yet.
Okay. And just to come back to the actual collapse of 3AC in the first place, do you personally trace much of that back to the collapse prior to 3AC's of Terra and Luna and that ecosystem? Because that seemed to be a big factor.
In a fund that large, no single position should ever collapse an entire fund. And so I think one of the things that I'm generally frustrated in as we look back on what went wrong in crypto, a year ago, or, is folks trying to sort of hang everything on the Terra Luna blow up.
Right.
It's like, okay, like this one currency blew up, but it wasn't Bitcoin.
I guess
it wasn't the dominant
they were big
currency.
Luna investors though, weren't they?
Sure, but it wasn't like, I highly doubt it was half their fund.
Right.
Or even a quarter of their fund.
Yeah.
And I don't know how much of their fund it was, but if it was half their fund, then you probably shouldn't be borrowing against a position in a relatively illiquid currency that's that big, right? So I do think that there's this whole thing where everybody wants an easy excuse, and the easy excuse is Terra Luna blew up, so all this other stuff blew up. Yeah. But I think really that's too easy. And the reality is, after the excess of that market era, we all needed to sit down and think about our risk controls, think about our risk models, and just think about how much we trust other market participants. And we needed to take a huge leap forward in how conservative the entire industry is and how vigilant we are about protecting the health and safety of the market.
I think it does look like we're out of time, but one last very quick question. Do you have any sense at all at this point in proceedings of where recoveries might come in percentage terms, or even, when you might start to see some recoveries happen?
I don't have a view on that yet.
Okay. All right, well, the clock's at 0, so hopefully we did okay in 15 minutes. Thank you very much, Peter. Please give Peter a big hand, everyone. Thanks very much.
Thank you.